All right, welcome everyone, in person and asynchronously later. I know we've got a bunch of people watching these at their convenience. So for posterity's sake, the date is June 15th, 2021, and we were just talking about the fact that we're shooting to reopen and go stampeding on July, whenever Stampede is. So that's where we're at today. It's a strange time, but we are rolling into session number 5 of our succession planning. So, as a quick recap, where we are on May 11th and 18th, we'd welcome Sylvia. You're not missing anything yet. I'm just doing intros. On May 11th and 18th, we did the 3-circle model, which is really worth watching, and the family business systems with Shauna Feth from the University of Alberta at the Alberta Business Family Institute. And that really, on your runway to transitioning out of your business or to buying a business, that really laid the foundation for the things that you want to consider, and some of the very typical and expected family conflict that may occur, and conflict within employees, key employees, longtime employees, purchasers, sellers, family members, and how those 3 circles intersect in all the different intersection areas. From there, we went through maybe my favorite one, which I don't know what that says about me, but the Financials 101 on May 25th. And I strongly encourage all of you to watch that and watch it more than once. That was Drew's take on not just how to read a financial statement, but the origin of the financial statement and the purpose and who was writing it and the audience they were writing it for. And that was incredibly informative. It wasn't just, T accounts. And then the following week on June 1st, we did business valuation. And that was a very dense, very meaty topic that Drew just put his head down and plowed through. That one is worth watching 2 or 3 times. And it's probably something that you want to watch with your business partners, your family members, and potentially even share that with, or any of these, with somebody who might be looking at purchasing your business. So today is June 15th. We've had a 2-week hiatus as Drew went on a much deserved vacation last week after tax season. He's over at JMH Accounting. And today we're going to go into succession itself, and financing a succession or a transfer. So this will be a very interesting one. And then a quick preface for June 22nd, our final workshop of the series, 6 of 6, is taxation and legal considerations. And Drew and Hillary Pritchard from Pritchard and Company lawyers will tackle that one. So, having said all of that, in the chat, I have Drew's email and the link to the YouTube channel so you can watch these and get caught up or review. If you need anything, please throw it in the chat. Drew will forge ahead as usual, and I'll manage the chat and keep track of any questions. So we've got a full house, and I'll turn it over to you. Take my ugly mug off the screen and mute my mic. Thanks, Drew.
Thanks, Mike. I'm just going to share my screen here. All right. So welcome to week 5 of the succession planning series. As Mike mentioned, Shauna was in the driver's seat for the first 2 weeks, talking about the 3-circle model and family business systems. Then we moved on to Financials 101, which was a crash course on how to read and interpret financial statements. Last week, or 2 weeks ago, I suppose, we covered the process of valuing a business. So Mike titled the series here, Succession Planning, and today's topic is just that, it's succession and finance. We followed some pretty logical steps to get where we are here today. We developed the process for reading your financial statements, identifying the key information that's being presented in those statements, ways to assess the reliability of that financial information. Then we moved on to using that information that was gained from those financial statements, along with other information, including the economic indicators, industry factors, business-specific risks, to arrive at what I call the appraised value for the business. So the appraised value, if you recall from last week's presentation, that's what the value that one individual sets as the value for that business. So today we're going to move towards taking that appraised value and turning it into a fair market value. So fair market value being what a willing buyer is willing to pay and what a seller is willing to sell for. So this is really how you take all of the value that you built in your business, all the blood, sweat, and tears you put in over the years towards financial success, and turn that into cash in the bank or a retirement plan for you. So one thing that I really believe is that no matter what stage you're in your business, it's never too early to start planning for your succession, or what I usually call your exit strategy. I always tell my clients, you never get into something without planning your way out. So that doesn't mean that once you set your plan, that's the only way, and you have to always work towards that. That plan can change along the way, but you should always have that one plan, that something that you're working towards. So I started to talk to my clients pretty early, and most of them have always had dreams of, I want to pass this business down to my kids. I want them to operate it. So they've always worked towards that. Now, in the end, maybe the kids don't have an interest in running that business. That doesn't mean you've made a mistake that you can't come back from. It just means that with that new information, now you need to shift your plan. You need to find another strategy and another way to exit your business. So by planning in advance for that exit strategy, the goal is to eventually help you get more for your business when it comes time to get out, or to make that exit a lot smoother. So preparing for your exit, if you've listened to my presentations in the last 2 weeks, you're probably getting sick of all my analogies and examples, but I really find that it's a much easier and relatable way to understand and for me to get my point across. So unfortunately, this week, again, you're going to have to listen to examples and analogies here, and probably a little bit next week as well. But planning for your exit strategy is a lot like planning to sell your house. Prior to putting your house on the market for sale, you're going to do some housekeeping items. You're likely going to keep a lot neater house, tidier than you normally would. Well, same goes for your business. So the first housekeeping item that you really want to look after is those redundant assets in your business. So I spoke briefly about this when we were looking at business valuation, but you should look at getting those assets out of your business. If you aren't using them in your business operations, they're likely costing you money. I mean, if you're carrying assets, there's going to be insurance associated with it. There's going to be repairs, operating costs, all that sort of thing. Those are going to be hitting your income statement. They're going to be dragging down your bottom line. So they're better off being sold or withdrawn from the business through your shareholder account, purchasing from the business, that sort of thing. So this should have a positive effect on your business's net income, which, again, recalling from last week's presentation, that net income is one of the primary factors that determines the value of your business. Plus, the perception to the potential buyer of having a clean asset listing goes a long way for the buyer's confidence. So just to quickly highlight what the cost of having additional expenses in your business is related to these unnecessary expenses or costs of redundant assets. So you'll recall last week, this is the exact same valuation that we used, where we came up with an enterprise value for your business of $996,000. So potentially that's our starting price. That's our appraised value. If you have, let's go with $5,000 a year of unnecessary or expenses related to potentially redundant assets. So what that does to your valuation is it actually dropped at $49,000. So there's a perfect example of why you'd want to clean up those redundant assets and why you'd want to get them out of your business prior to the valuation. Another common thing that I see is removing the land and building from your operating company prior to the sale. Now, if you want to sell the land and building along with your operations, that's fine. But what removing that land and building can do for you is it can decrease the asset value of the company. It'll lower your selling price. You're still keeping that asset. You can put it over into another holding company. But by bringing that purchase price down, you're potentially opening yourself up to a larger pool of potential buyers. When it comes to financing, which we'll talk about later, having the land and building included in the cost may make it a non-starter for some people that aren't able to get the financing for the business, plus the land and building in the asset listing. Again, it's not used 100% of the time, but it's a tactic that can be used in the right situation. So unnecessary expenses. Again, this is something that I spoke about last week in my presentation. Through the business valuation process, I noted that we take 5 years of financial statements typically. So as early as 5 years prior to your planned exit, it'd be a good time to start re-looking at your expenses and determine whether they're necessary or not. Normally, when you're starting up your business, your expenses are pretty lean. There's not a lot of cash available for these discretionary type expenses. However, later in your business cycle, it's not uncommon to incur some of these optional expenses. So we looked at the business valuation process briefly there, and that $5,000 can make a big difference. $5,000 a year for 5 years. Getting those out of the business, getting them into your personal out of your personal account can make a difference of $50,000 on that $1 million valuation. So another thing is it's important to recognize the difference between unnecessary or optional expenses and necessary expenses. So I'm not talking about near the end of your business, you want to start strip mining. You don't want to, keep it running extremely lean. You don't want to cut out things like advertising. I mean, it's needed to continue your business. It generates revenues. Stuff like that needs to be maintained. What I'm referring to is things like, easiest example is going to be your corporate golf membership. A lot of people run that through the business, not deductible for tax purposes, but it shows up as expense on the financial statements. Getting that golf membership, you're going to pay for it anyway. Getting it into your personal hands, taking it off of the business expenses can make a pretty significant difference there. And I mean, with golf memberships now around Medicine Hat, they aren't quite $5,000 a year, but I know on some of the larger centers, they can be upwards of that for sure. So that golf membership, it may have some business value. I mean, maybe you get some clients from the golf course or customers or some promotion, that sort of thing, but yeah, it might be better off going personal if you're looking at selling. So now on the flip side of the coin, if you're looking to exit and you haven't been reinvesting that capital into your business, I think you're making a mistake here. So your business might not be operating efficiently if you haven't reinvested capital and now you're running old assets. So some of your operating costs might be up. The buyer typically requests an asset listing, and on that asset listing, it's going to have the years of acquisition. So it'll be blatantly obvious that you haven't been putting money back into the business for the last few years. So if you're trying to, pool up some cash in the business for your exit, I suppose think twice about that. Make sure that your business is actually reinvesting and putting some money back into the assets so that it's running as smoothly as possible. The next item in preparing for your exit is contracts. So sometimes a large part of your business's value are what I referred to in the last valuation as intangible assets. One of those intangible assets could be your contracts, whether they are employment contracts with key employees or contracts with customers for future long-term service provision, contracts with vendors, So I'll use an example to drive this point home a little further. Recently, I had a client that was looking to purchase a commercial rental property. Last week, I used rental companies, or 2 weeks ago, I used rental companies as an example of a company that could possibly use the asset method of valuation. But my caveat there was that I won't capture things like rent agreements with tenants. So let's say that the property he was looking at was listed for $750,000. Should we look at the value of the building to determine the purchase price? Well, under the asset method, that's all we would look at. But if the building's sitting there empty and it's not generating revenue, it's worth less than it would be if there was an agreement with the tenant for the next 5 years to rent that building at a market rate. So by having that tenant locked in for a period of 5 years, you will be able to sell that building quicker and you'll be able to sell it for more. So same goes for key customers and employees. If you have key customers that utilize your services and products year in, year out, those customers, those are the ones that they put the food on your table and they deserve your special attention or some sort of special treatment. So there could be an opportunity for you there to put a contract in place for them. You know, we'll provide services or products to you exclusively. Potentially, there could be a slight discount provided to entice them in for that contract, but that slight discount, it might hurt your bottom line, but what it does is it secures your revenue. It'll reduce the risk. And when we looked at last week for business valuation, reduced risk in your business when you are selling equates to increased value or increased sale price. So that's one step to reduce the risk in your business. Let's lock those customers in. Let's get guaranteed revenue. Again, I'll throw out a real life example. I have a few friends in town that are commercial electricians. They're employed with various companies throughout Medicine Hat. And in 2015, the industry took a bit of a downturn. And some of them were sent all over Western Canada. They were chasing work around just to try to keep their employees busy. Their companies were slashing jobs, decreasing benefits. But there was one individual who, through that whole slowdown, continued to work with the same customers on the same contracts. So in that example, which business do you think is riskier? The one chasing work, incurring additional travel costs in order to keep their employees going, or the one with the steady monthly contracts? Assuming their profits are the same or similar, I know which one I would pay more for. So decrease that risk. Have those contracts in place, and they have value when you sell your business. Employees. So as I mentioned before, contracts. In my opinion, employees are the number one asset of your business. And when someone's looking to purchase your business, those employees can provide that value and stability throughout the transition process. Most businesses have a transition period worked into the purchase or sale agreement where the past owner will continue to work. They'll work on a contract basis, just ironing out wrinkles, making sure the changeover process goes as smoothly as possible. So I encourage any of my clients that are planning to sell the business to offer this continued work from the owner as part of the deal. It'll decrease the risk, decrease volatility, and again, it should increase the amount that the potential buyer is willing to pay. So in addition to the shareholder sticking around, key employees can be pivotal in increasing the value and stability of that ownership transition. If you have longstanding employees that are in important positions in your business, and those employees are committed to staying throughout the transition, again, it'll increase your sale price and decrease the risk. And like I mentioned earlier, more examples. A friend of mine purchased a restaurant pub here in town. He works in another industry, and this is a second revenue source for him. So he wasn't able to commit to being there 100% of the time, but he knew that there was a key employee in that business that had been there for 10, 15 plus years that was trained to manage that restaurant pub while he was away. Without that in place, he likely wouldn't have purchased that business. That gave the past owners the ability to sell their business, having that employee in place. So how do we work that into planning for succession? Be open and honest with those key employees. I'm not saying you open up absolutely everything to every employee, but you know who your key employees are. You know who the ones who are going to be key to the transition. Let them into that circle of trust. When you have a serious buyer, sit down and talk to that employee. Make them aware you're planning to sell your business. Let them know that the new owner really wants them to continue. Retention can make or break a business sale. Accounts receivable and inventory management. When we were analyzing financial statements and going through the business valuation process, one of the items that I mentioned was the accounts receivable and inventory turnover. So that accounts receivable ratio shows how frequently you're collecting your revenues, how efficient your customers are at paying you. The inventory turnover shows how well managed and how lean your operations are. In both of those instances, by focusing on your accounts receivable collections and properly managing your inventories, it's going to improve your business's cash flows, and it will improve your working capital in the business. Both of those, increased cash flows and working capital, will result in stronger looking financials and translate into a higher business valuation for you. I'm not suggesting that your AR and inventory management isn't good for what you're doing now, but there's always that room for improvement. So maybe take a look at your processes near the end when you're looking to sell, and maybe there's an opportunity to improve. Notice to reader, review, or audited financial statements. So back to the Financials 101, we discussed the different accounting and reporting engagements offered by accountants. Typically, businesses go with the notice to reader or what we call a compilation engagement because it suits their needs and it's the lowest cost at the time. But now your needs have changed when you're looking to sell your business. So maybe consider whether you need to move up to that review or audit engagement. Again, it might cost you a couple $1,000 extra to incur that review engagement, but the additional confidence that is given to your buyer for reviewed or audited financial statements might increase the purchase price way more than that increased cost will decrease it. Again, back to the increased risk means decreased purchase price. So the more we can do to decrease that risk, the more you should get upon your sale. And last item that I have on here in preparing for your exit, and I won't go too deep into this one, it's not really related to accounting, and Hillary from Pritchard & Company is going to talk about this next week, is make sure that your corporate records are up to date. So, that minute book, you should have your share certificates in there. Your bylaws should be relevant, your resolutions up to date, all that sort of stuff. Like I said, Hillary's going to touch on that next week. But again, something that's going to create confidence in your buyer, knowing that your legal side of your business is well taken care of as well. So that's preparing for your sale or preparing for the succession here. Next, we're going to look at the types of succession. So we've cleaned up the business, it's ready to go. Now we need to find somebody that's willing to take it over. So there's no real easy part in the business life cycle. When I was going through and I was putting this presentation together, I looked at many different websites and it talks about the business life cycle being startup and then growth and then stabilization, maturity, decline. And it's funny that a lot of them didn't actually speak anything towards exit from your business. Business owners go through a lot. Startup phase, it's tough just getting the bills paid. You aren't focusing on your exit. You're just trying to make it through. Once you finally get to the point where there's some cash flow available, you're looking to expand. You're looking to grow it, and again, things become tight. You're putting in those long hours. You're losing sleep trying to solve problems. You're putting all the fires out that you possibly can. The last thing on your mind is who's going to buy my business or who is going to take over my business. So we're going to cover two different exit strategies here today. One is the sale of a business, whether it's sale of shares or sale of assets. And then the other one is transitioning without a sale. Typically, that's when you're transitioning to a family member. So in the sale of shares or sale of assets, unfortunately with private companies, they're not as easy to sell when you have public company shares. If you want to sell your public company shares, there's an exchange, there's a stock market for that. You have access to the worldwide market of potential purchasers. For private companies, your list is quite a bit smaller. It's limited, but it's probably not as limited as you think. One quick thing before we jump into this is on a non-disclosure agreement. Before we get into the process of looking for somebody to purchase your business, before you provide them any information, again, I'm not going to go deep into this because Hillary's going to talk about it tomorrow next week. Non-disclosure agreement. You're providing details about your business to potential buyers. They could use that information that you give them to their advantage. So ensure that you have this non-disclosure agreement signed. Again, Hillary's going to cover what it does, what it is, who prepares it, who signs it, that sort of stuff. But it's very important to have that non-disclosure agreement in place before you start giving out your business's confidential information. So I guess when we're looking at potential buyers for your business, sometimes your number one buyer is right under your nose the entire time. So I talked previously that your number one asset is your employees. Well, potentially your exit plan might be your employees as well, and you didn't even explore that. I can't speak for other accountants, but for me, the most common sale and purchase scenario that I've seen throughout my career has been sales to employees. If you're looking at exploring this option, again, sit down with that key employee. We talked earlier about being open and honest with that employee when you're selling. Have a conversation with this employee. See if they are looking, if they're willing to go down that path. Start the conversation. You don't have to jump in right away. You don't have to start by giving them your financial statements and telling them everything that you do and what your role is in the business. And just start by, if they're interested, maybe, okay, let's give you a little more responsibility. Let's get you managing sales and collections or something like that. It'll only give them access to part of your income statement. They won't get to see the whole picture. They'll just get to see the top half, get to see your revenue. And if they're handling that well, maybe you move on. You say, well, okay, let's maybe look at transitioning some of the purchasing, some of the inventory management, payables management. Again, you're not opening up the whole books to them. They're only seeing a small portion. They're still in that top half of your income statement. Track their progress. Let them know. If their end goal is to purchase your business and they are the ones to buy you out, maybe help them move along, help them push them a little further than they'd normally be comfortable with. So if you're looking to transition your business to your employees, there are quite a few benefits in doing this. Number one is your business continuity. So we're all emotionally attached to our business. We all want to see our business succeed after our retirement. A key employee is most likely to continue on your corporate culture. You worked years to establish that culture, and they worked alongside with you. So they're going to maintain your corporate values. They're going to continue to employ the team members that you have working with you, those people that you've developed a relationship with for a number of years. So business continuity is a big benefit to transitioning to employees. Another benefit is it's less time consuming. You can spend a lot of time and effort trying to sell your business. First off, you're trying to find the right buyer. You're searching around. When you think you found the right person, now you have to provide all the necessary information. You have to try to convince them that this is the right business for them. Well, if the first person isn't the right one, then you got to go through and you're back at step one. You got to find another person. It's extremely time consuming. So when you have the employee right there in front of you, they already know a lot about your business. You don't have to spend a lot of time selling them on, how great your business is. They know, they've been working in it. Really, all you have to do is convince them that this business has this value, and your financials should speak for themselves in that area. Last benefit that I have noted here is ease of transition. So I mentioned that it's a time-consuming process to find a buyer and convince them. Also, the transition to the new buyer, if you're looking to get out and you're looking to get out quick, well, that employee doesn't have to learn your business. They were included in developing your systems, all the processes that you have in place. Yeah, they already have most of that information, so it should make the transition pretty easy, pretty seamless. Unfortunately, there are some costs or some downsides associated with transitioning to employees. As far as sale price, typically you're going to get a discounted sale price when you're selling to your employees. I don't have stats that would support that, but I mean, you're only shopping to one group of individuals. So if you get like an auction, you can get multiple people looking at your business and bidding on it, you're going to get more. If you've only tried employees, you don't know, maybe you could have got more. Another thing is financing. Typically employees won't have the assets or the capital to purchase the company outright. So maybe that means you have to take a more active role in the selling process. Maybe there's vendor financing, that sort of thing, which we'll talk about here in a bit. So I have now, what have I got? Two different ways that you can sell to your employees. Number one is what I call a direct share purchase. So this is, you simply provide them your retirement date, here's my expected price, and see if they're interested. Employees, like I said, don't typically have the financial means to purchase your business, nor will they have the equity to put down in order to get that bank financing. So it'll result in vendor financing deal being put in place. Lately, the banks have been requiring around 30% equity in for the sale of a business before they'll land on a business acquisition. But I've seen scenarios where even with 30%, they're hesitant to land in specific industries. In hindsight, it would have been nice. I maybe should have had a commercial lender available here to speak today on what their lending policies are, give specific details on specific industries. But I suppose in absence of that input here today, as a business owner, and especially if you're interested in exiting your business, I encourage you to talk to your banker. Ask them what type of equity would be required if somebody were to purchase your business. If you've done your own valuation, again, follow the steps that we went through a couple weeks ago, or have an accountant put one together for you. You'll know if you're comfortable with that price, and that might start you out in the process where you know what that 30% is. You know what amount might have to be put down. So assuming that that bank financing isn't an option, and I'm not saying it's off the table, I'm just saying you need to know your equity down first. The next option is your vendor financing. So I have some tips as far as vendor financing that might make the sale work better and could potentially reduce your risk. So first off, in your financing agreement, ensure that you have adequate security for the loan that you're providing the purchaser. Everyone's likely aware of the term general security agreement, personal guarantee. Well, get those put in place. If they default, At least then you have the ability to get your hands on some personal assets. There are taxation issues with having just the shares as security against the financing agreement and claiming the capital gains exemption, which we'll talk about later. So a general security agreement is preferred from an income tax perspective and from a risk management perspective. I think I saw a hand raise happen there, but I don't know how to handle that.
I don't see any hands raised. There's
I thought I saw Tim.
There's Tim saying you can always talk to your local community futures office. They have great small business advisors, which is true. I know some of them. I even like a few of them, Tim.
All right, that's great. Thanks, Tim. Another tip: incorporate a reasonable rate of return into that vendor financing agreement. So I wouldn't suggest entering into a non-interest-bearing loan. There's tax risks associated with that because you are not generating income from it. But on the other hand, a high-interest loan might scare off your potential buyer, or it might make it not economically feasible for that buyer. So what I would recommend to you as business owners is forecast your business's profits over the next few years while that loan is running out. Let's see if there's adequate cash flow available from the business to repay that debt. You can run those numbers yourself. Be reasonable in your forecast. I talked about being conservative when it comes to financial statement. Do a reasonable forecast of what the business will earn over the next 5-10 years. And based on your interest rate, is it feasible that the cash flows of the business over the next 5-10 years can pay off your loan? If it is, then chances are you're going to be in a great spot. If it's not, it might be a non-starter for this ownership transition. And another thing to explore when you are selling a business is there are a couple of options available if you're doing a share purchase. The employee that's looking at purchasing your business, they can purchase it personally, or they can set up a holding company to purchase those shares. There's advantages and disadvantages to each. Our tax topic is next week, so I'll put together a comparison between utilizing the lifetime capital gains exemption and not utilizing it. But just be aware that if you're, and we'll get to it later on the capital gains exemption, there's tax advantages to both. And again, that's subject to certain other restrictions, which we'll get to later when selling to family members. Option number 2 is employee stock options or an employee stock ownership plan. So this technique actually lets you bring in your key employees as shareholders a little earlier on than your point of exit. It starts that transition process through the use of employee stock options. If you have that key employee that you want to engage in your business, you can tie them into the business, into the business's financial success by giving them share ownership. This is one way to provide incentives to your employees, and it doesn't cost you cash flow. Part of their annual bonuses is a share of your business. It's not money out of your pocket. It's dollars off your sale at the end, but it's not money out of your pocket right away. So if you are tight on cash flow, there is an alternative. It's also a great alternative to offering pay increases or bonuses to these employees. If you can tie them into the profit of the company, or if these shares vest based on years of service, you're going to start the process. They're going to be engaged. They're going to be looking to transition. They're going to want more and more ownership if the business is successful. So you're setting up your succession plan by doing this. So through that employee stock option plan, what the employees do is they create a pool of money, essentially. Over a number of years, that pot of funds will continue to grow, and it's going to pay for your exit. Every time an employee contributes to the pool, they receive a share of ownership in the company based on the amount that they contribute and the valuation that's being put on those shares. If an employee leaves, that pool can be used to buy out that employee's exit as well. So they're pretty much funding their own exit at that point. Those funds can be invested, and eventually, if they accumulate, yeah, that's your exit plan right there. They do add some complexity from an income tax perspective, having employee stock options. But in Canada, there's preferential rules related to stock options for private corporations. As I mentioned before, public companies, there's an open market. There's an ability to sell your stock options immediately. So they have to pay tax immediately for public company stock options. Because there is not a market readily available for private company shares, they're harder to sell. There's a tax break right away. So, and again, there's arm's length transaction rules, which I'll get into later and explain those details. But employee stock options to family members, I strongly encourage you to talk to a tax professional prior to entering into that. But that's just one little snag that you can run into. But yeah, once that employee is provided those stock options, they're participating in the profits of the company. They can essentially use the profits of the business to buy out your remaining shares. If they're participating, they buy 5%. Well, now they get 5% of next year's profits, and it just starts that snowball rolling. So employee stock options are really a great way to get your employees invested in the business.
Hey, Drew, we got a question from Tim.
Yeah.
Have you ever done a purchase where common stock is sold, but the vendor takes convertible preferred shares?
We're going to get there. Great question, Tim.
All right. We'll park that for a minute. Thanks, Tim. Okay.
So the next option that we're looking at is the corporate share repurchase, which is kind of what Tim was asking about here, but not quite. My comment about using the company's profits to repurchase your shares was kind of a good transition into this next way of exiting as a shareholder. Now, this is assuming you're not the sole shareholder of the business. The company can buy back your shares through a redemption. Similar to that employee scenario, the company's using its profits to purchase your shares. Quick kind of side note, I won't get into too much detail on the legal side of things, but I mentioned this is for a business with multiple shareholders. Whether those shareholders are family, not family, related, unrelated, a unanimous shareholders agreement is something you should have in place. It is the equivalent of a prenup for a marriage, but in a business, and it should be signed while things are going good. Never wait until things are hitting the fan before you suggest a shareholders agreement. Inside of that agreement, there can be a clause that addresses shareholder buyouts, how the company's valued, and how to get into that process. Again, this corporate share repurchase, it might not fetch the same sale price as a third party. It might be discounted slightly, but if it's your only option that's available, it's your exit. So if this is your exit strategy, again, be open. Just like I said, be open with your employees, be open with your business partners regarding your timeline for your exit and your expectations. The more lead time you're willing to provide to them, the more they can plan for it. Potentially, the more they're going to be willing to pay. So yeah, just be open. Let them know when you're planning to exit. When we looked at business valuation, I think the very first item that we looked at was buyer and seller motivation. And if your seller motivation is high and you need to get out, your business partners are going to smell that out on you. They're likely going to offer you less. So from an income tax perspective, this exit from your business is less than ideal. If you're selling your shares, then you get that lifetime capital gains exemption, and it's taxed as a capital gain if they don't qualify, which is 50% inclusion rate. Well, when the company is buying back your shares or there's a share repurchase, this is actually going to result in a deemed dividend to you, which means fully taxable. Taxes as a dividend rather than that 50% rate. So I'm going to do an example of this next week when we get into the taxation side of this, but you're going to pay more tax if you're having a repurchase from the company versus a sale of your shares. I better speed things along here. So where do you start on looking for a private investment? So if you don't have that key employee lined up, maybe you're the only shareholder, so that corporate share buyback is not an option. Where do you start to look? Quite often I'm approached by clients. They say, hey, do you know anybody that's looking to buy or sell a business? You know, if you have somebody that's interested, you know, send them my way, that sort of thing. I am obligated by the rules of professional conduct of my industry to maintain confidentiality, independence. But if you give me the appropriate permissions as your accountant, I have the ability that I could potentially find a buyer. The same goes for your other advisors. So your lawyer, your investment advisor, your banker, yeah, and anybody that you trust that is advising your business might be able to help you. So beyond your advisors, you as a business owner, you likely have better connections in the industry than your advisors do. Customers of your business or potentially suppliers. Again, I'll reference back to the business valuation factors that influence your price, that buyer and seller motivation. You don't want to be going to your customers or suppliers desperate to sell. You don't want to, you know, I got to get out of here. I'm retiring. I need to sell my business. Do you want it? But, you know, if you trust these individuals, you have a good enough relationship with them, there might be an opportunity there. Let them know you're interested in fielding offers for your business. And you know what? Something might come out of that. If you don't get any bites from that, then again, the non-disclosure agreements, the access to confidential information. The next on the chain will be others in your industry, or what, to be blunt, I call competitors. It's less than ideal to go to your competitors and say, hey, I'm looking to exit, because they're going to get access to that confidential information. They could potentially get some business secrets. But if you've exhausted all your other avenues, you've tried employees, you've tried your advisors, you've tried your customers or suppliers, really what do you have left here at this point? Again, don't be desperate, don't be doing this last minute, but they might be sharing that market space with you. If they can get a larger market share, their profits might increase. Economies of scale, it'll work. Their fixed costs won't change significantly with more revenue. If they're getting margins, it'll add to their bottom line. You could be helping them out. And then last but not least, general public. So the reason I rank this behind your competitors is your competitors are obviously in that general public category. So as soon as you list your business for sale, your competitors are probably going to come sniffing around. They're going to want to take a look. So I would rather go to them first before you list your business for sale. I've seen a few businesses in town now listed with commercial realtors. Will assist you with selling your business. There's a fee associated with that. But if you're kind of, that's your last option, there's a fee associated with it you're willing to pay. Those realtors have access to a large network. They might be able to get you more for your business. So that fee might end up paying for itself. I better get flying here. So transition without a sale. When I talk about transition without a sale, what I'm referring to is a family transition, business transition plan. You're passing it on to the next generation. When I mentioned that the most common sale is to employees, that's the most common sale. The most common transition that I see by far is transition to family members. So first we need to lay out, I suppose, what a related party is and the related party transaction rules. So the related party transaction rules prevent you from entering into a transaction at something other than fair market value. So it can go both ways. There's instances where you might want to overstate the fair market value if you're trying to bump up the value of the shares or potentially farmland to use your capital gains exemption. However, in most scenarios, you're trying to understate the value to prevent paying tax. These rules are in place because, otherwise people would transfer things down generation to generation without paying any tax. As far as what is a related party, I have it here: individuals connected by blood, relationship, adoption, marriage, common law, partnership. So they're trying to prevent two people from working together to circumvent the tax system. I quite often hear tax planning strategies. People will come into my office and say, if I had $1 for every time I heard a sentence start like this. So I was talking to a friend the other day, and he said, okay, here comes the trying to get around the Income Tax Act story. There's reasons our tax act is so huge. They've tried to close as many loopholes as they can, and they also hold a big stick called the general anti-avoidance rule. That stops you from circumventing the tax act through a transaction or a series of transactions. They'll deny any tax benefits, all that sort of thing. So there's a quick Cole's notes on related party transactions and why these are slightly different than just a straight sale. You're dealing with family members. We need to understand the difference between common and preferred shares. So here's what we'll get into Tim's question about, let's swap our commons for preferreds, that sort of thing. So common shares are participating in the future value of the business, or what I refer to as growth shares. Any growth in the business from the time these shares are issued will accumulate in common shares. They're participating in the business's future profits. Preferred shares do not participate in the growth. They have a fixed value attached to them, potentially a fixed dividend rate or interest rate on those shares. So the way that a freeze works is you take your existing common shares, you put a value on them. You go through the business valuation process. And then what you do is you exchange those shares for preferred shares of the same value. So I have an example here in the slides. So 2 weeks ago, our enterprise business value was $996,000. Let's say there's one shareholder. This is A. She owns 100 shares, $9,960 each is the value. She has one child that's going to take over the business. She exchanges her 100 Class A common shares for 996 Class M preferred shares, redeemable at $1,000 per share. She now has a total value of preferred shares of $996,000. Your new enterprise business value is zero because the company has a debt of $996,000 owing to you. You've locked all of the value in those preferred shares. So now your child can subscribe to new common shares in the business at $1 per share. There's no benefit provided to the child. You're not circumventing the Income Tax Act. They're not getting something for free. This is available for non-family members as well. You can freeze out a shareholder, bring in an employee that way, that sort of thing. But there are risks associated with this. Mrs. A has not received any cash from the business. All Mrs. A has received is a piece of paper saying you will get cash. That cash has to come from the future profits of the business. So if the business tanks and it's no longer profitable, you're out your $996,000. So how do we prevent that risk? It's through control. So we talked about the difference between common and preferred shares. Now voting and non-voting shares. Control is established through voting shares. So if Mrs. A has 996 preferred shares, let's make those preferred shares voting shares. Now she has control of the company until the point that her share number comes down below that 100 shares that the child owns. That will give the freedom or the control to Mrs. A, and she can continue to control the business until she's bought out. Family trusts can also be brought in this scenario rather than giving the shares directly to your child. I'll caution you, there are tax on split income rules that came in 2017, 2018 that you should be well aware of if you are utilizing a family trust. But here's how a family trust would work. So exact same scenario, 996,000, you freeze it, enterprise business value is zero. Now the family trust subscribes for common shares. So the result is slightly different. So there's no benefit provided to the child, and 996 is locked in for Mrs. A. But now as control is maintained, and there is discretion over the distribution of any future profits. Because in a family trust, there's three positions that are available. The settlor creates the trust, and then they disappear. They're gone after that. The trustees are the ones who really control this family trust. They determine who gets those profits. And the beneficiaries are the ones that those profits are assigned to. So maybe Mrs. A sets herself up as a trustee in this scenario of the family trust. So yeah, she throws her value at $996,000, but she's controlling where all future benefits go. It can go to her kids, her grandkids, whoever's named as a beneficiary. She can be named as a beneficiary in that trust. So potentially there's an allocation of income back to her if she so desires. I think I might just scrap this one and add it to the start of next week's, because this is pretty important and requires a decent amount of time. So I kind of rushed through at the end there. I assume that there's going to be a bunch of questions because I wasn't able to go into the details that I wanted to. But to answer Tim's question, that was how the freeze works. That's the corporate buyback of shares. That's the exchange of common for preferred shares. Yeah, again, if there's questions, feel free. My email's in the chat. You can send me an email or just post them in the chat. And if there's enough questions, we might do a bonus session at the end here.